Hey traders, welcome back. I hope you all had a great weekend and a great Christmas. As promised, we've got a new trading idea that we're adding to our trading room this year, this coming new year. It's called the overnight vampire trade. So let's get into it. What is it? How does it work? Okay, so let's get into this. What is the overnight vampire trade? I have to confess, I feel like a little bit like Ron Popeil here, maybe. You know, from the makers of the Theta Fairy trade comes the overnight vampire trade. We've had a couple of creative names put together, but mostly by our trading members. But I think it's pretty appropriate for this particular setup. We're going to refer to it as the overnight vampire trade. And it does follow, I think, sort of in line with our Theta Fairy trade. For those of you that have been following our Theta Fairy trade, one of the things that's interesting about our setups is that we don't use back testing, we don't use theoretical P&Ls, we don't use modeling, we don't put in probability results. We just put up actual results. Our results are not theoretical. Our results are real. And the Theta Fairy trade for us this year has just been phenomenal. We've done over 60 of them. 58 of the 60 have made money. 2 have hit our stop losses. And this is a trade that is an overnight trade that has dropped about an extra $20,000 a year of income potential in our traders' laps. And I don't think any of us are going to retire on an extra 20 grand a year, but I don't think you would turn it down either. And I think that our overnight vampire trade is going to be a similar approach. It's very niche trading setup. It's not for everybody, just like the Theta Fairy trade is not for everybody as well. But there is a trade for everybody in our trading room. And so number one, if you're not familiar with our Theta Fairy trade and setup, I'll drop a link in the description box below for that particular overnight trade. It's basically just a trade that is designed to drop about $100 in our pocket each evening as we go to bed, hence the Theta Fairy name. And so let's move on now to our overnight vampire trade. So again, we have trading members from all over the world in pretty much every time zone that you can think of. And we also have what we affectionately refer to as our trading degenerates in our trading room that maybe are in a normal time zone, meaning US time zones, but we just can't get enough trading. If there's something to trade, we want to trade it. So we do trade 6 days a week. Inside of our trading room, we do start usually on Sunday evenings when the futures markets open up. And we do generally trade 24 hours a day. We usually do have some type of futures transaction going on that is working basically 24/6. And this is just another version of that. So again, it's a very niche trade. It's not meant for everybody. It requires a decent amount of capital, and it requires giving up one of your evenings of sleep, basically. So let's get into it. Let's talk about what it is. Well, once a month, this is an opportunity that comes our way. It's an overnight trade, and there's 3 potential steps in building this trade. So let's just pop out for a second and take a look at my brokerage account and pull up an options chain. Okay, so I'm going to go put in a ticker symbol here. Let's use the SPX for right now. And I do use the NASDAQ quite a bit in this trade as well, but we also use the SPX in addition to that. And let's go grab a options chain here. And I want to come down the options chain here and take a look at this. And you'll notice that as we go down the list here of option expirations, you can see that we have obviously options on the SPX expiring all week long. We also have some that are called quarterlies. These obviously expire once a quarter. We have weeklies. These are every single week that you'll see those pop up. And then every once in a while, and you'll notice that this usually corresponds with the third Friday of each month, you'll have an AM expiration. So the next AM expiration, and I would definitely, if this is a trade that you're interested in following along with this on, I would definitely put January 20th down on your calendar. Actually, it would be January 19th would be the day to look at this trade. But you'll notice that there is this AM expiration. And then again, if we come on down here and we keep going down the list, you can see in February, there's, again, third Friday of the month in February, there's an AM expiration. Same thing in March, same thing in April, et cetera, et cetera, et cetera. So once a month, you're going to have these options that expire in the AM. Now, here's the challenge with these. Generally speaking, we kind of make those options verboten in the trading room. We want to stay away from them because they have the worst of both worlds. Number one, these options, these AM expiration options, they don't have as much theta premium erosion potential, IV, however you want to look at it. They don't have as much credit potential in them as a 0 DTE, meaning an option that would expire later that day after the market closes, but yet they don't have the ability to be traded that day. So here's what I mean by that. On an AM expiration date, let's go forward here just a little bit. So an AM expiration, let's say AM expiration, and let's just say, let's pick a date here. Let's look at the next one that's coming up for us. Let's take that January 20th expiration. Okay, so we could go buy or sell these options on the day before January 20th. Again, this is a third Friday of the month. So on the 19th, we could go buy or sell these January 20th options. But once the market is closed, and again, we're not trading futures contracts, we're trading either the SPX or the NDX. So keep in mind, January 19th comes and goes. The market closes on January 19th. This January 20th AM expiration option now stops trading. So you've put a trade on the 19th that expires the morning of January 20th. Futures markets now, the E-minis, the NASDAQ minis, those are going to start trading. And as those trade, those are going to affect the price of the option that you bought or sold. However, the market on your SPX or NDX is closed. Market on the futures market's open, it's trading, it's moving, but the market on your SPX and your NDX is closed. And so you are basically just along for the ride on this AM expiration option. You're just crossing your fingers as the morning opens up and hoping that that option expires profitable for you. It is a really lose-lose situation. So, of course, we love the theory that every trade is a winning trade. Every trade has two parties, a buyer and a seller, and every transaction has a winner in it. If it's not you, it's the person on the other side of that transaction. So we love the idea of taking seemingly impossible or horrible setups, which the AM expiration options generally are referred to as horrible setups, and trying to build something powerful out of it. So again, what we're looking at here is a three-step process. We're going to go to these once-a-month opportunities, these AM expirations, and we're going to generally sell an iron condor on that AM expiration. Now, sometimes the market might be tilted to such a degree, have such a bearish or a bullish bias that we only do a credit call spread or a credit put spread. But generally we're trying to get as much premium out of the trade as possible. So usually we will sell a full iron condor on this, and we're going to do it about 10 to 15 minutes prior to the cash close on Thursday. So again, in this instance, it would be on the 19th, right? January the 19th. We're going to sell an iron condor on the January 20th AM expiration option. So that market's going to close. That trade is going to get locked in. Now that trade is pretty much set in stone. It's either going to make money or it's not going to make money. It's going to settle right as the cash markets open up the very next day. So we want to mitigate the risk of the futures market moving up and down overnight. And we're going to use a couple of additional steps here to do that. Step number 2 in the process is if we start to see the futures markets push towards the call side overnight, that's why it's called an overnight vampire trade, is that you basically have to babysit this trade overnight. If we see the future market starts to push to the call side, we're going to buy one long at the money, 1 day to expiration call. If it's pushing to the put side, we would buy a put. So it's either going to be a put or a call. And this is our first step right here in hedging this iron condor that we've sold. Now, in many cases, and you're going to see in the example that I'm going to show you here in just a second, this is enough. This can be enough to hedge that trade and let you feel comfortable letting that trade sit until the market opens. But sometimes it's not. Sometimes we get enough move that we're going to need to start to add some long or short E-mini contracts or NQ contracts, as the case may be. Depends which one of the indices we're trading. The example that I'm going to show you here in a second, I actually use the NDX, but the SPX is a little bit easier to trade, a little bit more profit potential in the NASDAQ, but a little bit harder to trade. So these are the 3 steps. We're going to basically sell an iron condor, step number 1, with an AM expiration, the day before it expires. Once the cash market closes that day, that trade is locked in. You can't get out of that trade. You can't exit that trade because the minute the market opens up the next day, it's already expired on you. So we're going to use step 2, step 3 to hedge that trade. We're going to use the futures markets to either buy a long put or call to hedge a directional move. We're going to use the futures contracts themselves to go long or short. Usually you can go 3 to 4 contracts, long or short here, to help hedge step number 1. So I'll show you a real world example of this. Again, we don't use back testing. We don't use theoreticals. We use real numbers. And these are my real numbers from the last AM expiration that we had. Now, I did use the NDX. So I did use the NASDAQ here. And you can see how these trades sort of laid out. So I started on the 15th. You can see December 15th is when we started the trade. That was the day before the AM expiration is going to take place. I started it at 1:42 p.m. my time. Now that's Mountain Time. So for me, the cash markets close at 2 p.m. So just about 15 minutes or so before the market closed. You can see all of this activity right here. I put a full iron condor in place on the NDX. So I committed probably somewhere around $50,000 on this trade right here. This whole trade right here was about $50,000 of buying power that I committed to this trade. And for me, I generally will use about $100,000 on this trade. Now we're going to look to scale this trade down to around $50,000. But again, I've mentioned this is a niche trade. It's not right for everybody. It's an overnight trade. You got to stay up all night and you got to throw a little bit of buying power at it, but you definitely get rewarded for it. So you'll see I put in this trade, put on the iron condor on the 15th, right before the cash market closes. The market closes, and you can see that Overnight, it did start, this is actually about 5 in the morning for my time, it did start to actually push a little bit towards the downside, towards the put credit spread. And so I did go long. I did buy one long put contract on the futures, the E-mini, on the NASDAQ E-mini. I did go long, one put contract. The market turned around. I didn't really need that, and so I bought it back. You can see I sold it back rather, closed it out. Bought it originally for $1,400 and got rid of it for $1,000, so it ended up costing me $400 or $370 for that protection. Here's the key part of this component. I brought in about $10,000 on this iron condor. I'm usually willing to spend about 20% of my income potential on protection. So I was actually a little bit below my expenditures usually here. I usually would be willing to spend a little bit more than that, but anyway, it ended up costing me about $370 for my protection here. You minus that out of my overall profit here, and then you will see in the morning, 7:30 a.m., that's when the cash markets open up right there. And you can see that they all closed out. They were all just basically expired. It did expire fully profitable, and it just basically was removed from my account. So all in all, for me on the $50,000 trade here, overnight, it brought in roughly about about $8,500, about $8,500 in overnight profit. And that's usually right where I'm trying to be. I'm trying to be right around 10,000 usually. But it is a nice trade. Now, a couple things again to keep in mind on the trade. Number one, it is overnight. You got to be able to monitor the trade overnight, and not everybody is willing to do that. Number two, I'm going to try to bring this down to about a $50,000 trade of buying power rather than $100,000. That should give us the potential to still bring in about $5,000 of profit potential. Let's call it potential. Okay, on the overnight trade. So not everybody wants to stay up overnight. Not everybody wants to commit 50,000 or has 50,000 to commit to a trade. But if you do, this is a new trade that we're going to be doing once a month going into the third Friday expiration. So hopefully that gives you guys a quick overview of what we're looking at adding to our portfolio mix this year. We're excited for that. If you do want to come trade with us, you can always come give us a try. Go to try0dteforfree.com, and we would love to have you come trade with us. Take care, guys. We'll talk to you soon.